Hello, everyone. Welcome to this edition of the LPL Research Market Signals podcast. My name is Marc Zabicki, Chief Investment Officer of LPL Financial. Joining me today is Kristian Kerr, who is our head of macro strategy. Kristian is responsible for running the day-to-day operations of our strategic and tactical asset allocation committee, the body responsible for the macro thought leadership of LPL Research. Kristian, first time on Market Signals podcast. Good to be with you.
Excited to be here, Mark.
Good. Glad. And we are recording this on Tuesday, February 20th. And before we get into the meat and potatoes of what happened in the markets, just want to talk about the agenda before we set up what happened last week, and then we'll get into what we think about markets as we move forward here. The agenda we were going to cover today, we'll talk a little bit about the market, recap, and Kristian will get your thoughts on some of that. I know you've got some specific viewpoints on foreign equity markets, specifically in Japan, things to watch there. And then the seemingly long talked about in this forum and other forums across capital markets is the lack of breadth in market leadership, and most of that market leadership is really centered in on the technology sector. We'll talk a little bit about that. And then a couple things that we're looking at as we sit here today this week, including the Fed meeting minutes, which were indeed on tap this week. So if we look back last week, it's the first losing week since January 5th, which was the first week of the new year. U.S. equity markets closed down, and global equity markets had a little bit of difficulty here and there, but U.S. equity markets were particularly weak, based largely on some CPI and PPI numbers that were less than expected. The CPI came in at 3.1% for January, and the market was expecting 2.9%. It felt like, Kristian, that the market had started pricing in some level of perfection. Would you agree with that, or what's your assessment?
Yeah, I think that's fair. Particularly when it comes to inflation, I think there's when you look at the beginning of the year, two things that consensus seems to be very clear about is that inflation has peaked and heading lower, and that we're likely to get either a soft landing or no landing. So I think when you set the bar that high, it's fairly easy to get kind of prints like we got last week that kind of make the market maybe double take or think twice about that. So I think that's what we saw. I think a lot of times it's about the path to get there. So we might eventually get to the goals or the end snare the market thinks we're going to, but it might not be a linear path. I think that's basically what would sum up kind of what happened last week.
Yeah, and it seemed like everything that had been working didn't work last week. Is that also fair?
Yeah, I mean, I think looking at this at kind of the performance numbers, precisely that. The one that stands out to me is, if you look at the S&P, down 30 basis points on the week versus the Russell 2000, which was, up 120 basis points. So I think that explains it pretty well. But yeah, pretty much everything that worked since pretty much the first week of the year reversed last week a little bit. Same goes for growth versus value, international versus U.S. So kind of that was the clear theme. I think it's early days really in terms of is this a major change in trend? I don't think you can really know that from a week, but definitely something to keep an eye on, just because the markets are so crowded in these trades at the moment that I think you need to kind of keep a weather eye on what's going on with respect to these rotations.
Yep. And same really for fixed income. And if we look, kind of at commodities as well, I mean, a little bit of weakness there across the broader commodity complex. But fixed income, I mean, you mentioned CPI. We talked about that at the open. not quite meeting market expectations, which means people have to kind of dial back their Federal Reserve rate cut expectations more in line with what we think. I mean, we're expecting about 4 rate cuts perhaps in 2024. I think the market was pricing in more than that. So certainly the CPI number helped dial that back, and that was reflected in the bond market. Anything catch your eye in fixed income?
Yeah, I mean, we basically priced out a full cut after all this, and March expectations are effectively zero now. I do wonder if it means, does this mean that the Fed is boxed in a little bit? And what I mean by that is it's a political year. So, if the Fed doesn't want to be seen as political, start coming September, can they really move if they want to? So it kind of, if we have a cut now coming in June at the earliest, it gives them 3, maybe 4 months to do quite a few cuts. So I think that could be a potential thing to think about if the Fed really isn't being motivated about not being seen as political. And in terms of kind of the performance last week too, I would also mention, if you had told me that the inflation surprise and how it would have kind of played out, the fact that commodities were so weak, in general against that was quite interesting, because you would have thought that would have been the chance for them to shine a little bit, no pun intended. But I guess kind of the main commodity that matters for the indexes would be crude, and it did have a fairly solid week. So perhaps just the composite of the index is what kind of reflects those numbers.
Yeah, and crude certainly helped the energy sector as well. So as we look ahead at this point, Kristian, the market's obviously been on a near parabolic trend since October-ish. And we talked about at the open how things have gotten a little bit frothy, as we say. I mean, what's your assessment as we look at today's market conditions and maybe using the S&P 500 picture as a backdrop?
Yeah, I think frothy is a good term. And we'll get into some charts that kind of show maybe some of the sentiments and positioning dynamics that are at play that warn maybe a correction, could be in the offing. These things are dangerous because we've basically rallied over 20% in 70 trading days, so a little over 2 months. So these things can extend. So it's a dangerous game to try to play for a top, but I think kind of a correction would not be necessarily a bad thing here. But listen, in the S&P, it's tough to look at this chart and get too bearish. We're holding gains above the all-time highs, well above these 50 200-day moving averages. So if anything, I think Adam put this together, our chart, Adam Turnquist, our technician, and pointed out the RSI divergence was happening, which would tend to make you think that there could be a corrective consolidation phase perhaps. So that's kind of where I'm at right now. Nothing negative at all in this chart, other than we've risen pretty far, pretty fast. But I think the proof will be in the pudding. We do get a correction. Ideally want to see kind of support, be found at those old highs, maybe down a little bit lower around those moving averages, and kind of how we react there will really determine, how aggressive this correction can be if we do indeed end up getting one.
Yeah, and as we talk about kind of linear progressions of equities, I mean I think which rarely happens in this market for an extended period of time on any asset price, but and true of CPI as well, where I think we went down in January CPI relative to where we've been in recent months, but it still wasn't good enough to satisfy the market, which I think just based on CPI, it's I think is well within our expectations, but the market it started pricing in some irrational expectations in terms of the directional change in CPI. What do you think about the entire thing?
Yeah, I agree with that assessment. I touched upon it a little bit earlier, but there are some lofty expectations priced in. If you look at some of the swap curves, August of 2024, the market's expecting a CPI print of less than 2%, right? So these lofty expectations, the more and more people get excited about them, there's a chance that you could get misses here and there. And quite frankly, the geopolitical situation, the war in the Ukraine, the war in the Middle East, these types of things tend to be a little bit kind of stoke the flames of inflation. So things to keep an eye on. I mean, I don't think this really necessarily changes our broader outlook, but just kind of be aware that the path to get there is not going to be this linear progression in terms of kind of going back to trend or subtrend inflation. And I think that's the most important thing from a market standpoint to be thinking about.
Yep. And then looking at the entire global equity complex, I mean, we've been thinking about U.S. As the key place to be relative to other global equity markets. I still think that's a fair assessment, but I know you wanted to call your attention to what's going on, or call this audience's attention to what's going on in Japan in terms of the favorable equity market prospects there. But we were hitting very interesting levels on the Nikkei, and I know this has caught your eye. What do you think?
Yeah, I mean, we peaked December 29th, 1989. So it's been 34 years since this index has made new all-time highs. I think we somewhat take it for granted in the U.S. Equity markets, always go up. And this is a pretty important chart, I think, for broader equities across the globe, and kind of just what it signals potentially from a long-term perspective for Japan. But kind of long-term 30-year plus highs, the same thing kind of happened in the U.S. indices after the 1929 crash. We didn't make new highs until the early 50s, and that was the start of a big secular trend. So perhaps some of that's going on. I think short term, whenever you get these 30 plus type year highs and you get to them, they're going to be a big psychological level for the market. I would be very surprised if we just broke through it and went up another 2,000-3,000 points relatively easily. So there probably will be a bit of chop here, but we're clearly at a big turning point for the Japanese equity market from a psychological perspective, from a price action perspective, and I think it's worth monitoring. We've been pretty positive on Japanese equities for a better part of a year now, and it's nice to see it kind of playing out. But I think if we do kind of get a foothold above those all-time highs, this market could get really, really interesting. And I think it plays into what we're seeing on the next chart with China, just because intra-regionally, you probably heard in the news, or there's some hedge funds that were playing spread trades essentially. So they were playing a bounce in China and a sell-off in Japan, which obviously hasn't really played out. So I do think with China, it's a big part of the emerging market indexes. Literally got weighted at almost near the top. But you can see here, this chart goes back to 2021, basically 30% down from those highs. We've had about a 10% rally. The Chinese policymakers are throwing just about everything they can at the market to try to bolster it, and it looks like they're finally starting to get a little bit of traction with that. Kind of one thing I just want to highlight here, and those white lines denote former lows, right? So big important inflection points, and typically, you can gauge the character of a market pretty well by how it reacts at old lows. If we've got up there and kind of just failed again and turned back down, that would be a pretty negative signal, to most technicians. And the fact that we were able to, from this rally post the Chinese New Year, be able to start to get a little bit of a traction above there, that's a clear potential positive of at least an attempt at a near-term bottom. We also closed above the 50 moving average, so you're starting to see some pretty decent technicals. In terms of how big or important of a potential shift this is, I think it's very early days. But the fact that we are starting to see a little bit of positive action here in the Chinese market, bodes well potentially for kind of a maybe a more important short-term tactical move by Chinese equities. But I think we probably want to see us start getting weekly closes, monthly closes, potentially above some of these technical levels to start talking more aggressively about a real bottom in China.
Yeah, and I know, I mean, we've been underweight EM in part due to the fact of the weakness you see in China here, and we've been, it's been a good trade to be underweight, broadly EM for the last 15 plus years, right? So yes. The points you make are good. Are we seeing what could be the early innings of a China bottom. We'll have to wait and see. Tactically, we think it's a little early to make that call, as you stated. We're still underweight, emerging markets, but these are the kind of things that we pay attention to. Going back to Japan for 1 second, I mean, obviously the market, back near its all-time high, is certainly newsworthy. What is the catalyst? What's been the driver in Japan this time around versus in decades past?
Yeah, it's a great question. I think in the near term, the catalyst was, and it didn't get much play, but it should have, is there was a probably the most important speech given by the Bank of Japan on February 8th. And they just highlighted very well that the way they approach policy is very different from the West, right? They have been facing, a deflationary problem for the better part of 3 decades, and they're not going to move until they feel it's time. So I think coming into this year, if you approach Japan from a Western mindset, particularly what was going on with inflation, I think Japan had inflation at 40-year highs or near 40-year highs to start the year. So the consensus thinking was, hey, they're gonna most likely normalize policy, and that speech kind of laid out that we view things different, and we're not going until we are certain that we have beaten this deflation back, right? And they're not certain yet. And the fact that Japan technically went into recession yesterday is another reason I think you're seeing kind of this leg up in the market here, because they're expecting looser policy from Japanese authorities. I think that's kind of the near term catalyst. I think from a longer term catalyst, they've done some things structurally that have been very positive. So making kind of the equity markets there a little bit more Western like, which is starting to attract, I think global capital back to Japan, and the fact that Japanese shares were basically on a price to book basis, kind of one of the more attractive G10 economies, to say the least. I think that definitely helped the story. So it's kind of a perfect storm of sorts, where you've got policy plus structural changes that are all kind of leading to a potentially bigger bull market in Japan.
Yeah. So if we think about just the broader market in terms of focusing back on the U.S., let's talk about what you're looking at across the market here in this country. Clearly we're top heavy in terms of the key names driving the market in terms of market capitalization. What does this chart show you?
Yeah, again, this put together by our colleague Adam, but just really showing the concentration in the indexes that's really driving the returns. It's not necessarily a bad thing, but it's also unusual, right? So depending on how you slice and dice these things, you can come up with a bunch of different ways to look at it. But I thought, one, if you look at kind of the top 10 stocks and their influence on an index, we're basically at the highest levels that we've seen since 1930s. And a couple of takeaways is not necessarily a negative thing, because a lot of times what you can see is that the broader market will catch up. So you just need a natural rotation, and kind of in S&P terms, the 490 starts to carry the load. That's a way that this can play out. The more negative way this would play out is that doesn't happen, right? And these top names start to lose a little bit of momentum, start to stumble a little bit, and then the rest of the market doesn't catch up. So it's more of a signal that this isn't usual. It probably can't last very long, and very long being relative. That could be quarters, but we've seen this for the better part of the year now. But just realize that the main point here is that this is an unusual situation. And there is some risk here, because of that, because it takes, I think we'll talk about it a little bit later, but the NVIDIA earnings announcement tomorrow, it's basically a broader market risk at this point. So I think you start seeing those types of dynamics. The indexes start to trade a little bit more like sector funds, essentially, because they're so weighted like that. So just things to think about when you have this dynamic. Again, not necessarily a bad thing, but just it's a little bit of a different game we've been playing when you have this type of concentration risk in the market.
Yeah. And speaking of concentration risk, with this chart, again, by Adam Turnquist, our chief technical strategist on market breadth, what's the takeaway here, Kristian?
Yeah, I mean, a lot of what I just said, right? I mean, I think this highlights it well. I will say it's unusual for a market to be making all-time highs like the S&P and to be seeing 52-week lows kind of getting stronger, right? Which is for lack of a better word. So that's an unusual situation. Tends to suggest that exactly what I was trying to highlight, that you have kind of just a few names leading the market higher, and you really kind of either need the broader market to start catching up for the market to extend, or you could be due for a little bit of a correction. I think that's typically what you would see from when you get kind of bad breadth.
Yeah, and I know this chart is one of your favorites personally. So, what it speaks to probably is what you have just been saying. Again, just a different way to look at it. What is it? What does this chart show you?
Yes, this is a mix of, from some research partners we have at Vanda, and they look at positioning in the equity market in a variety of different segments, right? So looking at certain institutional flows, certain retail flows, and kind of having a way to dissect it. The interesting thing to take away from here is that basically when we get to these extremes of positioning, so everyone buying the same things, this has happened, I believe, 7 times since the global financial crisis, 2009, and 6 of the 7 we've had pretty decent corrections from this positioning level. So again, not an end-all, be-all, holy grail that we're due a correction, but I think it is something that is a little bit of a warning sign that things have gotten a little bit too far too fast. And the fact that kind of everyone is in on the same trades is a warning sign that perhaps we might need to clear that out a little bit. And I'd also note, we didn't include it, but there's a host of these survey sentiment kind of data points, and one was the Consensus Inc., which I believe just looks at newsletter writers and even some brokerage firm kind of opinions, and that got to the highest, most bullish levels in 20 years last week. So clearly, everyone's kind of thinking the same thing, that everything looks rosy. And I think when you get to those types of points in the market, that's when you kind of have to think a little bit contrarian sometimes and say, maybe the market might need to pull back a little bit. So that's kind of what I see here. Again, very dangerous when you're in strong bull markets to try to be a top picker. So I'm not trying to advocate that at all, but just saying, have a little bit of a little bit of thought around, well, what do I want to do if we do get a pullback? What levels would I want to get re-involved in, or does it make sense lightening some up here? Those are type of thinking or questions to be asking yourself when we're at these types of levels in terms of price, positioning, sentiment in the market.
Yeah, and good, well said. I mean, I talked a little bit about this in the Street View video. I mean, if you're going to get out over your skis too far in the equity market, 2024 is certainly not. It's never good to do that anyway, but 2024 is not the time to do that, given all that's in front of us. And I mean, we've talked about some tools for the toolbox here, some of the things that we look at to kind of determine whether it's the right time to start thinking about a little bit of a contrarian view. I think we think that time is now. It doesn't mean we're not constructive on equities. It just means we're not expecting equities to go up in a straight line here. We thought we were going to have a fairly constructive year in 2024. It seems like we've gotten a lot of gains in a short amount of time, and that usually brings a pause down the road. In terms of treasury yields, obviously, again, we've pulled back a little bit in terms of prices, and yields have gone a little bit higher as a result of the changing Federal Reserve expectations. But what's the takeaway from this chart, Kristian?
Yeah, I mean, we've run up quite a bit in terms of yields. I think probably more than most people thought. We're overweight bonds, so don't really want to see us get too much above that 440 level in yields. That might start suggesting that maybe something has changed in terms of the narrative. But I think extended a bit in terms of yields, but I think so far reacting at levels you'd expect it and you'd want it to. And I think if we do turn down here and we get kind of that bearish price action that you want to see up against old highs resistance, I think it sets itself up for a pretty dynamic trade in terms of bonds higher and yields down. So, again, kind of did what it should have done given what we saw last week with the inflation numbers, but so far nothing really of significance in terms of technical damage. So looking for us to ideally fail somewhere around here, and then I probably get some sort of move back down, ideally down to those the old lows from late last year.
Yeah, and our target for the 10-year Treasury yield remains unchanged. We started the year, we posted this in actually early December, looking for the 10-year Treasury yield to end the 2024 around 3.75 to 4.25, and we're still thinking along those same lines. So correlation study here, Kristian, back to you on what the takeaway from this chart is.
Yeah, a couple of things. I mean, I would say we've started to see yields break, or equity sectors break from yields. Most of 2022, that was a driver, for example, and basically since the middle of last year, we started to see certain sectors start to change. And I think a couple things of note that really comes into fruition around earnings season, where you'll start to see, particularly with things like tech, you'll see that break from yields happen fairly aggressively, and we're starting to see that again. Key thing here, if I think in this chart, is that energy hasn't, right, and we saw that last week where tech got hit on the move higher in yields, and energy did well. So it's kind of, energy's been the one area it's almost somewhat defensive now, and it's been having a tough time breaking away from that dynamic. But I think in terms of what we were talking about, broader picture, in terms of the breadth picture, things like that, this yield dynamic breaking down would be a good thing, I think, for the broader market in terms of getting things to start trading a little bit different. And so I think there's something just to be on the lookout for over the next few months, is if we start getting these breakdown and correlations with the interest rate markets, that's probably a good thing for equities going forward, if we can indeed get it.
Yeah. Okay. Week ahead, clearly earnings, economic numbers as well, and then the all important FOMC meeting minutes tomorrow. Actually, the global PMI numbers should be also of interest. But in addition to NVIDIA, and I think we may have we don't have a chart on NVIDIA, I think, but you talked a little bit about NVIDIA and the earnings there, Kristian. So for your money, what's the thing that people should be paying attention to this week in global capital markets?
Yeah, I would actually, it's a great question. I would actually be a fade on the FOMC minutes. I don't think it's going to be that significant, but I'll give you a substitute, and that's going to be Chris Waller's speech on Thursday at 7:35 p.m. Eastern time. Waller has become a much bigger, important voice at the Fed, and he's actually the one that kind of kicked off the kind of the hopes about the rate cutting cycle starting earlier than was expected back in Q4 of last year. So he's an important one. I think the markets are a little bit confused right now. So he's giving a speech that's going to have a Q&A. It's an economic outlook. So I think that's a potential one to think about. It could be a market mover. It's going to happen when markets are closed, but I think that one's the one to be on the lookout for. And I think, the NVIDIA numbers are going to be important for the market, whether we like it or not. We spent a few minutes on concentration risk, and NVIDIA has been the primary driver of the indexes this year. So it's going to be significant. I think the call afterwards is going to have potential broader market impact. So I think when we're looking at it out ahead at the week, I think those two things are kind of what's on my radar. Obviously, I think the PMI to an extent could also be important. The minutes, I don't think it's as important because it comes. You're looking at backdated stuff. It's prior to a few key numbers and things like that. So it doesn't really give the market, I think, what it needs in terms of clarity with respect to Fed interest rate policy here. So that's why I think that Waller speech might be more important.
Okay. Well said. And Kristian Kerr, LPL Financial's head of macro strategy, I thank you for joining me today. Well, welcome to this Market Signals forum. I'm Marc Zabicki, Chief Investment Officer. Thank you all for joining Kristian and I. Be with us next week when Jeff Bookbinder will be back in this chair. Enjoy your week in capital markets.